Let's get across the market open now. Matt Short's joining us from Lincoln Indicators. Matt, welcome back to you. Let's start on Wall Street. It was an interesting session. Wasn't actually finishing in the red, but certainly some movement, or profit taking at least, out of some of those big AI related names.
Well, profit taking to say the least, and thanks for having me again. It's been a while since I've actually been on the program. Yeah, so at a headline level, the S&P down 20 basis points, didn't look like much. Nasdaq down 70 and the small caps down 40. So yes, looked like a soggy night, but if you do unpack that, most sectors were actually trading higher, and 60% of stocks on the S&P closed in the green. So if we dig into the detail, it was those, as you indicated, AI-related names that got really thumped. The Philly Semi Index was down 6%, memory names down 10%. So if anybody watches the Korean market, I expect that's going to get hammered again today. And even the picks and shovels names were hit quite hard as well. You've got Caterpillar down 7%, electrical contractors down 4%, and those data center players were aggressively sold down anywhere between 2 and 15%. And on the flip side of that, you've got the AI disrupted basket, like your software stocks that were up 3%. So that Sasarection trade may be coming back to the fore. Even your insurance brokers up 5%, exchanges up 4%, data providers up 6%. So it was certainly a move with winners and losers overnight. And sort of digging into this AI type of thematic, maybe or perhaps this is foreshadowing the year that we sort of have ahead of us. The reality is that the big hyperscalers and AI leaders have embarked on one of the largest capital spending programs in corporate history. And for over a decade, these companies have been swimming in a huge amount of free cash flow, but they've used that balance sheet in this AI arms race. But investors might start focusing on whether they're getting adequate returns on the largest investment in history, which will put into question whether the capital spending is sustainable.
Well, of course, we've seen that with a firm like Meta, massive capex, and some positives there overnight with they're actually now looking to sell, if you like, their excess capacity.
Yeah, I think that's a positive sort of development. And, those that have been invested in Meta, like we have in our US portfolios, had a pretty rough time of it. But Meta was actually up 10% because Zuckerberg is considering commercializing that AI infrastructure and, launching a cloud computing business, which effectively means that they'll be trying to monetize here and rent out their excess GPU capacity.
Now, just in terms of the macro moves we're seeing, we did get comments from Kevin Warsh overnight that forum in Portugal. But Matt, look, obviously eyes will be on the key jobs numbers that we get at the end of the week. Interesting what we're seeing in the bond market at the moment, pricing in 100% chance that the Fed will be lifting rates by October.
Look, I think Warsh has indicated it's data dependent, and tonight's going to be an extremely big night on that macro front because you've got three big job prints coming up. You've got payrolls, initial jobless claims, and unemployment at 11:30 tonight. So I think this is what bond investors are sort of looking to as their sort of indication as to what the policy is likely going to look like for the rest of the year. I think markets will be broadly hoping that the numbers come in line with expectations, which would indicate that labour's cooling, but there's no crisis. But a big beat, which has been, I guess, the last three prints have comfortably beaten expectations on the positive side, that would put pressure on an additional rate hike this year, which would be bad for equities, I would think.
Now, just in terms of what we've seen in commodities, so pressure remaining on oil. Do you get the sense perhaps this has been overdone by the market? Obviously, we've seen movement in the Strait of Hormuz, but clearly there's no resolution to the conflict. Both sides still negotiating.
Look, I didn't expect it to come down to the level that it did so quickly. Just sort of given that Hormuz, yes, is somewhat open, but certainly near as many tankers are passing before the initial conflict got underway. But again, I think the market's listening to Trump, and he's saying that negotiations are going beautifully, and we're continuing to believe him. So paper market's trading at I think 68 overnight for WTI, which is well beyond my expectations, where I was sort of expecting oil to sort of rest in the 80s to 90s for the foreseeable future. So, look, it does indicate every time Monday morning comes, there's a Axios report indicating that negotiations are going well, and all the fighting happens to start on the weekends. So it's one of these weird little cycles that we're in at the moment. But I've scratching my head at oil prices at the moment.
Well, indeed. Now, Matt, I'm interested to get your view on gold at the moment too. Obviously, having come under tremendous pressure over the course of the war, has bounced back a little. Are you seeing opportunity there, particularly in terms of equities?
Look, I think the gold miners are reasonably well placed, and certainly not expected relative to the numbers that they're currently producing. So on that front, I think it's reasonably safe to start having a look at that particular sector. But the gold price, clearly is what everybody's looking at the moment. Looks like it's finding some support at around that $4,000 mark. Medium term, we're still quite bullish on gold. We sort of expect that government spending is going to remain quite rampant. Geopolitical risks and that geopolitical landscape continues to sort of look messy. We think central banks are likely going to increase exposure to gold, which should be supportive. But quite clearly, from the highs of January, it became a very crowded trade, and now gold is starting to be far more correlated with equities, which is quite surprising at this point. So I'd be looking at gold miners, but waiting to sort of see a positive trend line appear in the gold price.
Well, Matt, more broadly in the resources sector, certainly that's been strength here on the local market. Look, we are expecting to open lower this morning, but overall, what are you watching for in the Australian market?
Well, look, what I'm expecting today is a tale of winners and losers. There's going to be a pretty wide berth between stocks that do well and poorly. I think miners are going to underperform. That was certainly the indications that we got from the ADRs overnight. BHP and Rio likely going to be weaker. Anything exposed to this AI thematic, I think we're going to follow the US. So data center names are going to get sold quite aggressively, I expect. And those picks and shovels businesses, the contractors, are also going to come under some pressure. But on the flip side, Life 360, for those that are interested in that stock, that was up 6% overnight. And my expectations are that the software names will probably trade quite well today. And even your software, or not software, insurance brokers, remember those names came under increasing pressure as an AI disruption victim. I think they're going to find some support with broadly financial services. And what I've noticed, I think, across the Aussie market more recently has been a lot of those stocks with a lot of short interest. Looks like there's a bit of covering going on. I think that's part of the reason why CSL has rallied off that 92, 93 low. And I expect that potentially a lot of those names will continue to trade quite well today.